Good afternoon, ladies and gentlemen. I would like to welcome you to part 3 of our CFO series. This is a three-part webinar series focused on three major issues facing CFOs and finance leaders today. In today's session, we look at some important red flags in corporate tax planning. The objective of this webinar is to flag some critical corporate tax issues of concern for the CFO group, which should be kept in the radar while they handle the entire gamut of financial aspects of their companies. A little bit about ASA and our speakers today. ASA is a 30-year-old accounting and consulting firm with a team of over 700 professionals spread across 8 offices in India. A major part of our focus is on foreign companies setting up and operating in India. Today, we are one of India's foremost accounting and consulting firms, assisting our clients in setting up their business, M&A, partner search, audit, risk advisory, taxation, and compliance issues such as accounting, payroll, IFRS, etc. Our speakers today are Sunil Arora and Yogesh Mittal. Sunil leads the taxation function of the firm at our New Delhi office. An expert in international taxation, he advises companies on operation strategy in India, structuring issues, tax planning avenues, expatriate taxation, due diligence, and devising transfer pricing policies and defending them before the tax authorities and appellate bodies. Sunil has successfully represented his clients in contract negotiations, various tax and appellate bodies, including at the Commissioner of Appeals and the Dispute Resolution Panel. Coming to our next speaker, Yogesh Mittal is the CFO and lead strategy for JBM's Environment Business Projects. A chartered accountant with over a decade of experience, Yogesh has held key leadership roles in the finance verticals in companies like Indigo Airlines and Renew Power before joining the JBM Group. As a tax expert and a finance leader, he has worked on tax disputes, international business, and strategic collaborations like joint ventures, investments, and transaction structuring. Yogesh is a regular contributor to Taxman's publication and a visiting faculty to several premier Indian institutions and universities. Before we begin, here are a few instructions for the webinar. Please note that all the participants will be in listen-only mode throughout the webinar. If you have any questions or comments, please put them in the questions section in the chat. The presentation will be followed by a Q&A round. A link with the recording to this webinar will be emailed to you. Thank you, and over to you, Sunil.
Thank you, Vikram. Thank you very much for this introduction. Friends, today the topic is more on the tax side, but if you look at the series that we have been carrying out, the series of the CFO seminars where we first took up, similarly red flags when you talk about your audit, your financial statements. Then we spoke about issues relating to digitization of businesses. Digitization is as much a threat as an opportunity. And then this is the third part of this series. And today we are going to be discussing about issues on the tax side. And, primarily the focus is going to be on the avenues or areas which are perceived as threats for the CFOs, for the heads of the finance functions, essentially with the direction to try and understand, are there any opportunities to save, let's say, any cash outgo that is happening in your company on account of tax? Is there something that you haven't explored yet? And obviously, when you miss out on opportunities, that is something that looks like a threat. Is there a threat that you're not foreseeing at this point in time? Is there something that you should ring fence your business against? Is there something specific in terms of safeguards that you need to follow? Any tax optimization schemes, any rationalization schemes? Today, compliance is a big issue. How do you rationalize your cost in terms of compliance? Are there any potential savings that you can have? Are there any specific red flags attached to non-compliances that you can avoid? Similarly, issues in various directions. So what we've done is we have picked up issues based out of sheer experience of dealing with businesses, let's say more specifically in the last 2 or 3 years, because due to COVID, there has been a lot of learning in terms of how one looks into the business, how do you manage calamities, how do you find opportunities in calamities. So this experience is primarily based on last 2 to 3 years. And with that, I will take up my first issue. Give me the next slide, please. The next one, please. So I think first and foremost, and something which is clearly a red flag is the issue on transfer pricing. Transfer pricing, I've been practicing transfer pricing for 20 years now. Thanks to COVID, in any case, it was overwhelming, it was exceptional, but thanks to COVID, the situation has, is completely, the tables have turned. Transfer pricing anyways is an issue that is largely debated in courts. And I was reading the newspaper this morning. They were saying a very famous transfer pricing issue in terms of AMP, the advertising, marketing, and sales promotion cost. There is a judgment which is going to be coming very soon, and a lot of businesses are depending on this particular judgment. So, transfer pricing is one angle, but what COVID has done is COVID has shown us a mirror in terms of what could possibly go wrong, what could change for a business in the most drastic, in the most unexpected manner. And the change which COVID has brought about is not a change that we will see for 1 year. You're going to see the impact over multiple years. You're going to see the impact not on one business division. You will see it spreading across business divisions. I was speaking to a company where they had two business divisions. One was on the auto side, the other was on the healthcare side. Healthcare suddenly obviously started doing very well, whereas the auto business suffered a lot. So, different strokes and different things that have happened. So what are we looking at? What is so much, why is COVID bothering us so much in terms of transfer pricing? Any and every aspect of business is undergone a change. You look at your supply chains, you look at your contractual obligations, you look at your financial consistency in reporting, you look at your decision-making pattern, assuming that some businesses were centralized with the headquarters, now you are an Indian subsidiary. In COVID times, you had to take decisions on your own, take matters in your hand. Your funding requirements have changed. Digitization came much earlier. Maybe you were trying to grasp getting a grip of digitization in a routine manner, but that came much, much earlier. Now not all businesses have suffered a loss. As long as your businesses have suffered gains in terms of the impact of COVID, everything is fine. But the moment businesses have turned into a loss, and why only COVID? Loss could happen because of other issues also. COVID is one typical case of economic downturn, but you could have losses in terms of business strategy related issues. So let's say one bad example, one bad decision, let's say in terms of the products that you introduce in the market, and you could suffer losses for multiple years. You could not recover costs for many years. You could have losses related to startups. Startups essentially are based on a cash burn model, not on a profit making model, and therefore you will have to assess your transfer pricing approach in that particular manner. Foreign exchange is a big component which leads to losses in businesses that are highly dependent on imports or exports, and therefore I think the most important point when you talk about impact of COVID and why we should be concerned so much about COVID and the manner in which we understand the losses is that it's very important to identify the nature of loss that you have incurred. Unless you understand what is the ecosystem of the loss that you are trapped in, it's very difficult to take the next logical step. And what is the next logical step? The next logical step is the adjustments that you could carry out in terms of the losses that you have. And these adjustments could be multiple. For example, in COVID times or even in different times where there is the possibility that you were not able to use your capacities. Now, in those cases, you will need a capacity adjustment. Similarly, there could be adjustments on account of other factors, but again, you need documentation, you need a business case to make these adjustments. And again, when you talk about transfer pricing, the only word that comes to mind is documentation. And therefore, whatever you discuss in terms of transfer pricing, any argument that you place before any authority is as good as the documentation that you use. What has COVID done to this whole situation, the whole problem? Now, because of COVID, and I've been reading a lot of publications coming out of different countries, COVID will entail an enhanced level of scrutiny. Authorities would want to know how did you behave specifically in terms of COVID. What did you do which was extraordinary? What did you miss out on? What was the critical change in terms of your functions? Businesses making losses will be heavily scrutinized, not just in India, globally. And the best part here is the onus in this case is on the taxpayer. You have to prove you're bona fide. You have to prove that your losses are not owing to related party transactions. The other problem that you're going to see is that in the market, everybody has had different business cycles. So, and the reportings have been delayed. So one thing that you will face is that there will be inadequate comparable information in the market. Even your own internal information will not be enough to compare yourself with a transaction that you want to benchmark. But having said that, COVID is also an opportunity to try and see that were you ever operating on realistic levels or not. For example, look at the case of back offices, right? Now these back offices, they were operating on 15, 20, 22% under whatever pressure, under group policies, under the APAs that they might have agreed with Indian tax authorities. Now is the time to relook at your levels. Is the market generating enough profits to give you a 20, 22% margin over cost? Is it realistic or not? Is something that you have to see. And obviously, as I said, impact is not just 1 year, it's going to be multiple years and different business divisions. I've already given an example to this side. Now, what is it that you require? And as I said, COVID transfer pricing boils down eventually to documentation. So what is it required from your end? Because since you have the owners, all it is required is that you need to be in a position where you can feel that you have made a strong case, a very strong case in terms of the documentation that you collect, in terms of the processes that you have laid down. The rule is simple. It's a related party transaction. You have the onus to establish ALP, not just ALP, you have the onus to establish the genuineness of the transaction and whether or not any benefit arise from that transaction. That's a very critical part. What is the objective? The objective is to demonstrate that the loss is not owing to related party transaction. And I can give you a very clear example here. Also, something linked to the next point. We were sort of arguing a case in case of a company which was into smart cards. If you remember, smart cards comes in different capacities, smaller capacity smart cards, higher capacity smart cards. There was this company which sort of sold the smaller capacity smart cards at a price which was unsustainable in the market. Now, the reason they gave was they said they wanted to capture the market, and it was a conscious business call to sort of recognize a loss in a couple of years, in the first initial couple of years, so that they build a market strong enough to sell cards at a higher capacity, higher margins cards. Now, obviously, there was an issue. The transfer pricing officer was not very convinced with the whole discussion. Something that essentially saved us, and the way we were able to sort of create a defense around this discussion was that we looked at the director's report that was given in the financials. The director's report very clearly mentioned a business strategy, a conscious business strategy to build a case around selling lower capacity cards in the beginning to gain market share, so as to leverage the business benefits later. That worked very well, and that brings us to the point that how important it is to match and to synchronize your financial reporting with your business strategies. Now, whatever you may say, you are a finance guy, you're going to be writing numbers. You don't know what's behind in terms of strategy. What is it that the board of directors have decided? And therefore, it's very important that both the statements talk to each other. You have to, sow the seeds at the very initial level so that it's very easier for you to defend at the later level. So, what is the lesson? The lessons we have learned is that document whatever you consider as material. Create an audit trail, and it could be anything. It could be business vouchers, emails, office memos, anything and everything that gives you the comfort that you have documented what you have done, the genuineness of the transaction that you have carried out. So one of the ways that one also handles or tries to justify performance that has not been extraordinary, or you have extraordinary losses there. Let's take, for example, the situation of COVID. what one would do is, it's very easy to define a situation where you have a situation but for COVID. So you compare the situation with COVID and you compare the situation but for COVID. Look at the impact, look at the variances, look at the critical factors that have been affected, and that will give you an answer and a justification to give to the tax officer that look, these are the factors that have gotten affected because of COVID or any other calamity. Look at what auto companies and others are facing due to shortage of chips in the market, right? Therefore, they will have to show what exactly is the situation before and after this particular situation happened. Again, you will have to very clearly document what is the nature of the loss and who should be bearing this loss and why. What is the rationale behind it? And again, just to conclude this matter, and that is, I think, the key takeaway from this discussion is that after having done all this, if you still don't find a solution, try and look into alternate dispute resolution avenues. You already know about APAs and you already know about safe harbor. If you already have APAs in place, try and renegotiate it, because anything and everything relating to business has been changed. Now, a typical call of action in this particular case is act now. Do not wait for the tax officers to come after you and try and chase you. What you can document today, you cannot document tomorrow. Your assessments are going to come after 2 to 3 years. It would be too late by then. Talk to your business, talk to your salespeople, try and document as much as you can now. Next slide, please. Next slide. Okay, I think another area which is obviously of concern is on the prosecution side, and we thought it would be interesting to discuss, when you talk about prosecution, where does the buck actually stop? For me, prosecution is very clearly something that instills the fear of God. And we realize that given the technological advantage that the tax authorities have today, there is absolutely no way you can escape any deemed section that invokes penalties or prosecution. What we've discussed here is the ambit of the prosecution that you see here are the most common aspects of prosecution, or aspects that lead to prosecution. Any taxes that you have not paid deliberately, any attempt to evade tax penalty or even interest liability, you have not evaded, but you are evading the payment of that liability. You do not furnish your tax return. Anything and everything can lead to prosecution. Again, this is the worst case, but today this is something that you cannot avoid. Imagine the good old days. You were to file paper submissions. Paper submissions used to get lost. What you file will be seen at leisure. The tax officer's discretion will apply there, whether he knows about prosecution provisions or not. There are lots of ifs and buts in a tax case reaching to a stage where prosecution might apply, but not today. Today, everything is operated on a software. If there is one default, the system will automatically pop up that this case is also subject to prosecution. All the tax officer has to do is he simply has to tick, and you will have a notice in your ITBA portal. And the prosecution is quite severe here, and it also includes fine. It could be anywhere between 3 months to about 7 years as a case. Now, when you talk about prosecution, the next possible question is that whether compounding is possible in cases where prosecution applies. Now, compounding is possible, certainly possible, but there are two factors that are critical here. One is that compounding essentially is on the discretion on the commissioner or the chief commissioner of income tax. The taxpayer does not have an inherent right to seek or to demand or to press for compounding. Only if it's a bona fide case which shows merit is the case which the CIT or CCIT is going to consider for compounding. And we are not getting into the modalities of how compounding happens. Now, also bear in mind that there are some offences which are non-compoundable. So if there is a case of Black Money Act, if there is a case of Benami law, if there is a case of you hiding foreign assets, these are the cases where prosecution where compounding does not apply. And there is a straightforward case that you find for prosecution. A complaint could be filed and prosecution could be invoked. The most important question here is, where does the buck stop? Who's responsible when you talk about prosecution? The law is clear, although not very clear when it trickles down to the sort of designation of the person who is responsible. So what the law says is law focuses on prosecuting the company and the principal officer in the company. Both are responsible. Who is the principal officer? That is the most important question. That's a moot question. Now, principal officer is the person in charge who is responsible for conduct of business, who is responsible for taking critical decisions. Interestingly, directors or managing directors are not deemed to be people who are principal officers. The income tax officer who is invoking penalty of the prosecution proceedings will have to serve a specific notice and explain to the director why he wants the director to be a principal officer in charge. It is not direct. Is there a clear threat on CFOs? I would say yes. Given the fact that the Companies Act already recognizes a CFO as a key managerial personnel, or you could not call them a CFO, call them head of finance, call them head of tax, essentially key managerial personnel. I think, and subject to the hierarchy of decisions that you take, whatever has been approved by the board of directors, I think there is a valid case if CFOs were to be treated as principal officers, and they are the ones who might face or might be taken to task in terms of application of prosecution proceedings. Now, there have been multiple cases. Actually, as a matter of fact, post 2017, 2016 is when the Black Money Act came. Post 2017, there has been a sudden spurt of cases. The Central Board of Direct Taxes came out with a very clear direction saying that try and invoke as many prosecution in these cases wherever you find evasion or concealment, instill the fear of God in taxpayers. That has increased manifold, and there are multiple cases. High Court of Karnataka, Delhi High Court. There have been tribunal judgments where even the most bona fide of cases have been pulled into prosecution. I think this is a very, very serious issue, and one must bear this in mind. CFOs have a responsibility to take care of this particular red flag. Next slide, please. Now, this is something which is more of a post-mortem, and why we are doing this post-mortem is because this relates to the issue of dividend distribution tax, something which was in application until about last year. And what it did, basically, there has been a case by the Delhi tribunal in the case of a German company. This was a case which came out in October last year. This case has validated a theory that the rate of dividend distribution tax should be subjected to the maximum rate at which dividend income is taxable in the hands of the non-resident under the tax treaty. And that's where we say it's a near possibility. It obviously will apply to people, to companies who have made profits, companies who have distributed dividends. This is not a future issue, but this is something that comes as an opportunity, something that you can explore if the merits justify in your case. So what it essentially says is that, and this is a chronology of the arguments that have been validated in the judgment by the Delhi tribunal. They have said that any non-resident is taxed in respect of India-sourced income in India, but these provisions are governed by tax treaty. Now it says very clearly, says tax treaty says there is a, for example, Indo-German tax treaty says there is a cap of 10% rate of tax on the dividend income earned by a German corporate, right, who is a beneficial owner of shares of the Indian company. Now, the logic is, and that's where they are contesting, they are saying the section that had triggered dividend distribution tax, the intent of the section was always to tax the non-resident. It was only a mode of collection that the law said, that the regulators said, that the Indian company distributing the dividend should be made to pay this dividend. In all practical sense, the dividend distribution tax that is paid is a charge on dividend income of the non-resident, and therefore the rates under the tax treaty should apply. So, for example, if dividend distribution tax is 20.56%, it could have been only restricted to 10%, and the tribunal validates this argument that there is a case that you can go back to the tax officer and ask for a refund of the excess taxes that you have paid. What we have given to you is different treaties. We thought it's going to be a ready reckoner for you, and you will see various tax treaties. Some due to the MFN clause, you will see a 5% rate, but it's mostly about 10%. So there is a possibility of tax refund. I think the information that I have is none of the companies today have actually received a tax refund, but a lot of companies have admitted their application at the first level. What will essentially happen in this case is that once you've understood that the merits of the case deserve an application like this, you're going to file an application to the tax officer. The tax officer may or may not respond to it. The chances are they will not respond to it, and therefore you will then have to approach the high courts either through writ, or if the tax officer responds to it and rejects your claim, you will obviously have a chance to go and represent a matter, file an appeal before the tribunals. This is again a post-mortem, as I repeat, but again a very critical issue for those who want to augment more cash out of the taxes they've already paid. This is a near possibility since Delhi Tribunal has validated this. Companies in Delhi obviously have a better case than others. So this is something that may be experimental. Next slide, please. So tax technology, I think, and why is there a need to talk about tax technology? As I said in the beginning, tax technology is as much a threat as it is an opportunity. Why an opportunity? Everybody understands. Obviously, it facilitates what you do. It takes care of mundane tasks. Any recurring thing that you're doing is captured. You have information at your the click of a button, dashboards, the works. We know why we need it, but why is it a threat? I think the biggest reason that we see this as a threat is that India happens to be perhaps the only country where the tax regulators are moving faster in terms of technology implementation as compared to the taxpayer. Look at the new portal that they have put in place. Obviously, with all the bugs that are there, but the intent is very clear. Intent is that we want a tax portal that is a portal of the future. And I will give you other examples that you will realize that how revolutionary the vision is, how revolutionary they are trying to make the system, and how it's going to become a problem for you, and what can you do to sort of take care of it. So this is an ideal tax function. I'm not going to get into what an ideal tax function is. I think all of us here, there's been a lot of things that have been said and told about an ideal tax function. But what is it? What are the essential questions that we should ask? And I've listed a few. I think the question that we should be really asking is, let's say if you're a company which has multiple tax issues, the first question that you should be asking is that, are you consistent in your tax approach? Let's say you have two separate bids handled by two separate business managers. Have they ever spoken to each other? Have they ever spoken to the tax teams? Have they ever spoken to the finance functions to understand what is a common stand that could be taken in terms of the cost of tax that needs to be placed in the bid, right? By the way, we have seen live cases where companies have faulted on this aspect. 3 or 4 critical contracts, different positions taken, not very carefully analyzed, just because they did not consider it as essential to try and centralize the decision making on the issue of tax. Now, other sort of flag is that are we missing any critical deadlines? Are we entering into the zone of recurring non-compliance? That's a sign for me that I need to look into technology more seriously. What sort of reporting, what sort of repository have we created? What is the knowledge enhancement of the people that support me on the tax function? What is the knowledge enhancement to the business that does the entire bid making? What is the speed of your decision making? You know, anything and everything around this is going to help you. Last but not the least, what is the audit trail that you maintain on a corporate level? From a corporate governance perspective, you know, your auditors would also like to see what audit trail that you have before taking a decision. So I think this is a desirable structure, but not all entities may require all of this is the first stage, but you will realize very soon that you require some thing in bits and pieces. For larger enterprises, I think there is everything is required. Next slide, please. some of the areas we thought could be critical from a technology perspective and something that is directly affecting our lives in terms of us handling tax advisory and people, tax people, let's say Yogesh's team handling the tax function. What are the impact areas? One classic case of an impact area is look at Form 26 AS, right? It used to be a simple statement of TDS, TCS. Now, there has been a recent notification, and by way of this notification, the scope of Form 26 AS alone has been so dramatically enhanced. The scope of disclosure is so dramatic now that this is not a static form anyway, by any stretch. This is a live form. It has, all the information in the world that you require. They have tied everything together. So your GST, your customs, your Benami law, your black money law, your turnover, your import, your exports, anything and everything is put together in your 26 AS. Any penalties that were imposed on you, imagine you have quoted in your tax audit report that there were no penalties levied, but Form 26 AS is right there in front of you. It won't lie, right? And there is going to be updation happening every 3 months. How will you escape? Besides this, they are also using this information as a tool to exchange information under the bilateral treaties. So don't be surprised that if there is a transaction that you have taken cross-border, let's say in the US or in the UK, don't be surprised that this transaction is appearing as an information item in your Form 26 AS. So therefore, I don't think there is anything left to say here. It's absolutely critical for you to maintain a real-time reconciliation. How will this happen? Obviously, you will have to go back into one of the functions, one of the limbs of the tax technology that we discussed. You will have to have a 360-degree, a live, dashboard running in front of you to try and see that your 26 AS should automatically talk with the information that you have on your dashboards. I think that is something that is going to drastically reduce the risk of tax investigations. Similarly, I think faceless, it's been there for about 2 years now, and we do a lot of faceless assessments with authorities. Anything, assessments, appeals, penalties, anything and everything is today faceless. There are very few set of papers that we file now on a physical basis. Rules of representation have changed. The rules of game have changed. Unless you have a tight control on the financial information, on the tax positions that they've taken, on the decisions that the board of directors have taken, believe me, you will neither have the time nor the accuracy nor the finesse in your statements that you submit. And look at the person looking at your case, he's not looking at your argument, right? He's nothing to hear, there's nothing to submit in person. All he has is a piece of paper in front of him, and he's going to judge you on that. Any mistake, any inconsistency in that piece of paper, you have lost the game. And then starts the cycle of getting into appeals and paying consultants. And again, when you talk about any sort of control, any sort of risk area, it's very important that you should have internal control. I think we've spoken a lot about it. We have spoken about dashboard, repository, and obviously robotic process automations. By the way, we are applying internally in our firm also, we are applying robotic processes. We have devised tools that can talk to the IT portal, income tax portal, and sort of extract the basic level of information for us, and which we can then process in a more refined manner. So we don't have to today now spend time on looking into each account, entering each PAN number, entering each password. This is the most simplest of process automation that is available today, and we must look at these sort of aspects very, very closely. Next slide, please. This is the last set of my slides, and I thought this is going to be important from a CFO's perspective. This is cash kept in your business, something that you never realize. And in these times where the cash flows are very tight, we believe businesses must understand that this is an opportunity. Unless you sort of leverage these opportunities and others are leveraging these opportunities, you are losing out, and this is something that you must do. So one particular aspect is on the lower tax withholding certificate. Now, what is a lower tax withholding certificate? It's a very simple, straightforward document let's say you are a loss-making company, or you are a low-tax company any which ways, or let's say you are a company which runs high-value projects, and in these high-value projects, the size of revenue is very high, whereas the profits and the effective tax in comparison to the size of revenue is very, very low. Now imagine if there was a deduction of 10% if you're a foreign company, at 40%, or even a 2% on projects that give you a margin of 0.5, 0.7. Typically large projects could have very thin, wafer thin margins. What do you do in these cases? In these cases, you obviously must find a way out where you could approach the tax officer, try and make a case where you say that, look, my average rate of tax in the last 3 years has been very low. Every year I've been coming back to you asking for a refund. So please, this year, allow me to go back to my clients and tell them that they should withhold a lower rate of tax when they make a payment to me. So if it was 10%, they should withhold 2 or 3%. If it was 2%, they should withhold a 0.5% or a 1%. If it was 40%, based on the calculations that you have done, it could be 5, 7, 8, 10, 12, whatever percentage you want. Now, obviously, large turnkey projects, they will do it invariably. We have done, we process more than 100, 150 certificates every year, and this is very, very handy. Saves immediate cash to the business. Now, what is the merit in your case? How do you assume that this is something that will give you advantage? Now, first, I think the first prerequisite is that you have to make a very strong case. And how do you make a strong case here is that you have to bring out very clear advantage with supportings on why you feel the average rate of tax has been lower and why you feel the rate of tax in this year is going to follow the average rate of tax. And once you have won the, justified these matters, the battle is half won. The next set of issues is only to sort of negotiate with the tax officer. How best can you sort of reduce or get them to a path where they understand your business, where they understand your case, and try and give you a much lower percentage. Believe me, this is immediate cash saving for businesses. Something, if you're not doing this right now, look into this, talk to your tax advisor. Past tax refunds, that's again a very critical aspect. Again, businesses are starved for cash today. And any sort of money that is held up with the tax officer is something that you must get. Now, monies could be held up for any reason, small technical reasons, or for legal reasons. And these legal reasons could be that, you might have had a bad assessment and the officers are holding up the refunds for a previous year to be able to set off against the outstanding liability that you have. Now, this is a very interesting aspect, and of late, the courts have discussed a lot about this particular aspect. The issue is, you should nevertheless try and push your refunds. There is no doubt about it. If you see no action happening at the tax office, push it. If there is an inordinate delay, if the tax officer is not responding, you have all the right to escalate the matter, try and exhaust all available options that you have, to the extent of going to the High Court and filing a writ. That is something that you must examine. But there's one critical aspect that still is there, is that in a lot of cases, the tax officer is going to adjust the refund against the outstanding demand. Now, if you all are sort of familiar with the stay of demand provisions, there has been a circular by the CBDT which very clearly says that if there is a tax demand and the taxpayer pays 20% of that demand, you should generally be able to seek in abeyance of the balance 80%. Now, following this analogy, following this instruction, if the tax officer ends up adjusting anything beyond 20% of the outstanding demand, you have a case. You can press the tax officer and ask very clearly that, look, as per the CBDT circular, all you were required to adjust was 20%. Anything beyond that, 10, 20, 30, 40, 50% is my money. Give me back the money. Obviously, if there is no response, if this is something that the tax officer does not agree to, you obviously know that you have options open before you, again, including escalating the matter or approaching the high courts with a writ. And I think this has been a issue with a lot of corporates. And maybe I should ask Yogesh at this juncture. Yogesh, what do you feel about these particular aspects? Over to you. You're on mute, Yogesh, to unmute yourself.
Yeah, Sunil, thanks. Yes, most helpful. These are certainly the tools and avenues that CFOs and people like me have deployed over these years for cash augmentation. The lower tax withholding certificates you mentioned about the 20%, the demand provision. Yes, these are the ones which need to be looked into more carefully by the CFOs and the tax heads, and they create a significant impact in augmenting the cash of the business as we go along. So yes, most helpful, and this is actually not even the future. I mean, this is the present that we are living in, and need to be looked at more carefully. Yeah. So moving to a few of the industry relevant issues within tax domain, if I were to give my point of view, then to the entire gathering, the first thing I would like to mention, and this is in continuation to what Sunil has been discussing. The first thing is the MAT on exempt incomes. Now, as a tax professional and as finance person, we all have our delights in earning the incomes on which no tax is levied, and incomes which are specifically exempt under the normal provisions of the Act, and it's a delight for anybody. What happens is that once a particular stream of income is earned, then because of accounting implications and requirements, it has to be clubbed in the book profits of the company. Now, despite being a tax exempt income, and when we take that number of book profits in preparing the normal computation of income, we tend to reduce the exempt or the tax-free income, or specifically exempt income, if one were to say, and we basically compute the taxes on the balance taxable component of our incomes and pay the tax accordingly. However, the question arises that when the same book profit is taken under section 115 JB for MAT computation purpose, again 18%, 18.5%, and now 15%, the MAT is leviable on that particular book profit. This section or the MAT provisions are self-sustained code of the statute, and it does not, they stand independently. Now, what it means is that something which is otherwise exempt under the normal provisions, or not even income per se under the Act, could there be legally a foundation on the taxpayer to include something which is coming as an accounting profit and include that for the MAT computation purpose? So the anomaly is very clearly coming out that on receipts which are specifically exempt or which are not incomes per se, MAT is leviable, and the question arises, is it technically tenable for the MAT provisions to be levied on such receipts or not? So interestingly, there have been certain case laws and positions that assessees and taxpayers have taken in this regard. Examples of such income could be, the capital gains which are exempt under section 47 of the Income Tax Act, the duty exemptions such as, the excise duty waiver in the pre-GST scenario, waiver of borrowings of the loans which are being taken, forfeiture of share warrants, things like liquidated damages when, the whole project of a particular entity or a taxpayer is shifted for a certain duration, and a capital receipt of, so to say, a liquidated damages arise. Now, when these receipts are included in your profit and loss account as income, and it is not one of the excluded items as provided under the MAT provisions of 115 JB, what do? You mechanically take the book profit number and just put 18.5 or now 15% tax of the MAT on that. In some of the cases, what we have seen is that the taxpayers made specific disclosures in the notes to accounts. And this was to the effect that so and so income is either exempt under the Income Tax Act or it is not even income, and therefore the book profits which are to be taken for the MAT computation purpose has to exclude that income. So the taxpayers included that specific disclosure or note in their notes to accounts. When this position was tested by the honorable tribunals, and there are quite a few number of cases on this aspect, it came out clearly that the word book profit has to be determined how the financials of a company depicts. And financials of a company not only means the number which is appearing as a profit figure in the profit and loss account, but also that number need to be read with the notes. And if you look at the two, in conjunction, if you read the two together, you pick up the number and you read it with the note, then the actual amount of book profit would be excluding that exempt income. And basis this analogy, there have been case laws at the tribunal level or the special tribunal level where reliefs have been granted to the taxpayers, and this actually is becoming an area of deliberation and further detailing that the tax-free incomes or receipts which are not income per se within the ambit of the Income Tax Act, is there a way to avoid not only the normal provisions of income tax but also MAT through this? I would say that till now, there have been certain honorable tribunal judgments which come to the rescue of taxpayers. However, there have been certain judgments from Bangalore Tribunal, if I remember vaguely, that where this position was defied by the honorable tribunal, and they concluded that the MAT provisions need to be examined and implemented more technically and more strictly, and this liberty of reading the profit number with the notes to accounts of a taxpayer, this cannot be entertained, and it has to be the MAT computation has to work in a more conventional manner. So clearly, this is an area of and deliberation. But if I were to, from my point of view, give a call for action, it's basically a careful examination of all the receipts appearing in the profit and loss account. And if it is clearly coming out that under the normal provisions, a particular receipt is exempt or not to be considered as an income per se, the MAT implications on that need to be examined very carefully. And also the CFOs and the companies need to, and the taxpayers need to ensure that adequate disclosures and proper disclosures are made in the notes to accounts, in order to take a position that such income would merit a non-levy of MAT as well. So I think this is the message I would like to give, given the position of this particular matter, please. Request for the next slide, please. Right. If I were to give you another point of view on a matter which is becoming quite robust in terms of tax controversies and discussions, is basically the taxation of share premium. It's a fairly normal practice that a company at a holding level creates multiple subsidiaries down below for doing the projects, and we see in several industries it's quite a very common phenomenon. And whenever this is implemented, Holdco creates several subsidiaries down below and make investments into that. Typically, the shares are issued at a certain premium. The controversy started arising from 2012 onwards, particularly, and before that it was existing in a different format. But after 2012, the enablement was made in section 5627B, where it was said that if an Indian taxpayer, means a taxpayer, is receiving financing for issuance of shares from a resident investor, it's not a non-resident investor. This is what I want to highlight first. So if an Indian resident investor is making investment in a closely held company, which is not listed or which is not widely held, in that situation, the share premium which the investee company would charge to the investor would have to be justified. And if the share premium charged by the investee company is appearing higher than the fair market value of those shares, then the enablement is created for the income tax officer to deem that particular receipt the excessive, the share premium over the fair market value, to deem that particular component as an income of the investee company and levy tax on that. So this is the premise. How it started is a little, if I were to take a step back, the section 68, where the cash credits and several of these, shareholders and the transactions were rooted with parties who didn't exist. And to curb those kind of malpractices, the enablements were made in the income tax. However, from 2012 onwards, if the legitimacy of the shareholders are established, the money have come to the investing company through the normal prescribed banking channels, but the shares are issued at a premium, that too to a Indian resident investor, then this position is going to be checked. And how it basically has to create an impact is the valuation rules for deriving the share valuation or the premium is prescribed under 11 UA of the income tax rules 1962. The valuation methods are also prescribed. Then the taxpayer is at his will to choose either the discounted cash flow method for arriving the valuation of his company or the net asset value. And on top of that, it has to be backed by a certificate from a category 1 merchant banker or chartered accountants. And there's a little controversy out there whether a chartered accountant can do a DCF certification or not. This has to be to the satisfaction of the tax officer. Now, one side of this theory or this provision is that mechanically you are required to follow certain rules, prescribed procedures. The other side of that is that it has to be made satisfaction to the tax officer, which means that he can challenge and question at any point in time. What is the practical implication of this provision happening? You see, on one side, the industry requirements requires you to go into a 2-tier, 3-tier structures where beyond one holdco, one has to create multiple subsidiaries for doing business. And the business of compulsion comes from the lender requirements, the PPA conditions in case of renewable energy, and so many other requirements. If out of this one were to do that and issue shares, looking at projects and looking at things which justify the issuance of shares, also submit a category 1 merchant banker report and prescribe and follows all the prescribed procedures, the income tax officer can still challenge that. The income tax officer have conventionally been challenging that the taxpayer acceptance to one particular adoption of one particular method with respect to the other one, and this have been fairly controversial provision over the last couple of years, I would say. The matter is achieving some sort of a finality. It is moving in the direction where some fruitful and valuable judgments have been announced by the honorable tribunals, and a majority of them have been in the favor of the taxpayers, that on the choice of method, on once a particular document and has been submitted and all the prescribed procedures are fulfilled, is it really open to the tax officer to still challenge it or not? So these are some of the things which are still brewing as far as the tax controversy, but at least it has started to move where the positions are being tested by the honorable authorities, and a lot of it is getting settled with the with the advent of time. The important thing here is that these provisions are not applicable where the investor is a non-resident, and also when the investee is a listed company or an eligible startup. Now, if you are having majority of the cases where you are not falling within these exceptions, then one, you have to follow the prescribed rules, and secondly, now the call for action. You have to ensure a robust case. In the last couple of years, any company who has issued the shares at a premium and not falling in the exceptional category, I don't think they would have been able to avoid any sort of a tax litigation around it. So given that this is a matter which is out of the business exigency and requirements is coming up, and at the same time it's drafted in a manner that it is going to be tested, the real call of action and to say that having a proper documentation in support and having a proper record keeping backed by a very well reasoned valuation report will be very crucial. One more thing which a lot of people like I'm a CFO and people like me do is that, let's say the valuation report of category 1 merchant banker sometimes says the real valuation of per share of a particular investee company comes to, let's say, 98 rupees or 99.5 rupees, and we still tend to issue the shares at 100 rupees thinking that I have the liberty to round up anything I want in life. The balance 2 rupees, the balance 50 paise multiplied by number of shares could actually become a taxable income and subject to tax at the maximum possible rates. So these are some of the things that, even the implementing bodies, the taxpayers also need to examine and be careful about. And at the same time, prepare ourselves well for the tax litigation, because this is, a given thing as a situation been in the last couple of years and still relevant today. Let's go to the next topic, please. Yeah. Now, this is something that a lot of people like me would be able to relate instantly. So Sunil, so many years we've spent, thinking that the moment it is a software payment made to a non-resident, it is a typical case of royalty. We've had, several of the decisions, AARs and honorable high courts and decisions everywhere where, it was very clearly coming out that, copyright versus copyrighted article is certainly at the helm of the controversy, but there were decisions coming on both sides. And come 2012, and sort of a retrospective amendment is made, and then it was given that, guys, no need for the controversy. Now every software payment is a taxable receipt. And fortunately, you said, Sunil, a lot about the COVID. So I think it's a blessing in disguise in the COVID situation. Decision came, if I'm not mistaken, in March 2021, just a few months back, by the Honorable Supreme Court, and that seemed to be settling, a big controversy. Now, if there is a non-resident software provider anywhere in the world, and he's providing the software for distribution to an Indian distributor, or is providing software to other distributors for distribution in India, and it's a typical case where you are not giving any right, where you're not giving any right on an exclusive basis. You are not giving somebody a right to create copies or to commercially exploit that product and things like that. The Supreme Court very clearly says the transfer of that software is a copyrighted article. It is akin to selling products. And when you transfer the ownership, then you just have to examine if the software provider has a PE in India or not. And if it doesn't have, then gone are the days of software royalty. This is as simple as that. However, the exceptions are that if somebody were to really pass on not a copyrighted article, but a copyright itself, like it's on an exclusive basis, it's on a non-transferable basis. If one software provider in USA says to the Indian guy that not only am I providing you the software, I'm giving you the right to commercially exploit, make as many copies as you want, or do commercially whatever you've been looking for. So all those situations are fairly covered by the law of land, and we are thankful for this. However, I would like to go to another controversy that before this judgment came in 2020, the budget mentioned about the expansion of the equalization levy provisions. Earlier, see, from 2012 to 2020, they were leviable on only on the online branding and advertisement. But from 2020 onwards, they started also levying that on the e-commerce providers for platform of goods and services. Now, does this mean that it's a happy affair that the 10% royalty case, which was earlier applicable, is now reduced to 2%? Or the taxpayer should be worried, or should be having difficulties that a tax rate which was originally has been brought down from 10% to 0% is now reinstated back to 2%? So while one controversy clearly seemed to be having achieved a finality, that in case of a copyrighted articles and this thing which comes out very clearly in the software and the licensing agreement, basis that if one were to say that there is no tax withholding, no tax liability in India, basis the decision of the Supreme Court, still the 2% tax which is applicable on the e-commerce operators by way of equalization levy, that would still have to be discharged. And so one were to obviously look at the whole situation more carefully. But I think the call of action right now in the current situation, sir, is about about how one drafts the software licensing agreement. And if it is in the attempt of the taxpayers to bring very clearly out that it's a transfer of a copyrighted article, I think a lot of controversy and litigation will go away just by achieving that simple thing. And my suggestion and my own learning out of the whole situation is that while drafting that particular agreement, let's try to reduce the gray to the extent. And if it is a copyrighted article, or if it is a copyright, let's bring it out clearly. And there are situations where it remains gray. One has to deal with it out accordingly, but the careful drafting of the agreement and what rights, entitlements, obligations, etc. are granted from the transferor to the licensee, that will hold the key to settle this position in the going forward scenario. So these are some of the issues, Sunil, which I thought would be relevant from industry and from our point of view. A lot of it, like you said, are being fought, are being settled at the appropriate forums, and the law enables us to file representations and appeals, etc. However, there are certain things which, in my point of view, the industry must raise more proactively to the concerned decision makers. And by filing representation and making our voice heard at the appropriate forums and in the appropriate manner, I think industry and the tax administrators and stakeholders can jointly achieve significantly more than what we can do by fighting these cases in courtrooms and brewing the controversies. So this is, I think, a message I would like to give my point of view with. Thank you. Thanks for the opportunity. So, Bikram sir, over to you, please.
Thanks, Yogesh. Very interesting presentation, and I'm sure we've all learning a lot from these things. Time is short. We are just overrunning, so I'll just take a couple of questions, and then try to wrap it quickly. I've received many questions, but I'll just try use my discretion and take out a couple of them. First one is, should all the corporates reconsider their current TP approach, and how should they maintain adequate safeguards from future tax inquiries? Sunil, if you can take this one.
I think I can answer it briefly, and the answer to this is, I think, yes. I don't think there is any business that has not been affected in the last 3 or 4 years, either by way of COVID or any other extraordinary situation. So I think, to my mind, transfer pricing is anyways a very sacred area which relies strictly on the sort of documentation that you maintain. And I think, given that the entire world and the economies are sort of relooking, re-evaluating, and on a recovery path, some are on accelerated recovery path, some are on a more linear recovery path. This is the time to present a case that is more realistic. And so I think it is very important for you to relook at your transfer pricing. Relook at each contract, relook at each relationship. There is nothing that stops you. If there were some comparables you were not using in the past, but due to this COVID situation, you think there are near comparables now. Companies that have changed form, substance, use this to your advantage and try and present a case that is more closer to reality that you believe in. So I think that would be my answer.
Right, Sunil, fair enough. Another question is on the issue of MAT. Is there a High Court judgment also on the matter highlighted in the presentation? Further, just by mentioning in the notes to accounts, would this be a sufficient safeguard? Yogesh, if you can take this one.
Yeah, sure, sir. Sir, in my opinion, as of now, the decisions which are either favoring, majority of them are favoring the taxpayers, are at a tribunal level. I don't think the matter has reached out still to merit attention of High Court as of now, but I think it should come out soon. Even the decisions where the matter has been decided against the taxpayer, they're also at a tribunal level. So that's where it is. This is a very interesting point in the second sentence which you said, that merely by disclosing in the notes to accounts, is it possible to claim something as exempt even from a MAT? If I were to give you my point of view, I think, sir, there is a decision, if I'm not mistaken, in Mumbai Special Tribunal in Shivalik Ventures. The answer to this question is given in a very technical and very articulated manner. They say the book profit is not the number. It has to be read in conjunction with the notes to accounts. So if I'm earning 50 plus 50, 50 taxable income and 50 is not income at all, And because of accounting, I have to club both of them together, and my P&L credit, it has to reflect as 100. The 100 which I pick up as my book profit for my MAT computation purpose has no meaning. It has to be read with my notes to accounts. And my notes to accounts said that please exclude the 50 rupees because it is not income. And if I do the two together, the number plus the note together, then I arrive at the correct book profit. And that is how my MAT starting point is. And I think then here it here it answers the question that merely by disclosing, yes, sir, because the disclosure read with the number actually is the correct and technical position to arrive at the number of book profit, which will be the first step to start computing the MAT. So this is how, sir, I would like to respond to that. And to my mind, it should be a disclosure thing. And even from a penalty and prosecution perspective, a fairly well articulated disclosure and notes to accounts would actually serve the purpose. So one has to look at it in with that perspective.
Yes, point taken, Yogesh. The next question is, what is the realistic expectation when we approach the tax officer for a lower withholding certificate? Sunil, I think if you can take this up.
I think I've already spoken quite a bit about it, but in terms of how you make a case, the sort of challenges that you faces, and that will define the sort of realistic outlook to this whole issue. In some cases where there could be cases where the applicant has multiple clients. How do you then apply for a certificate in the name of all those clients? Is it possible? Technically, yes, but how much of information that is there, that is available to you, is accurate, and how much of it can you substantiate by way of the contracts that you have signed with these clients, and with what certainty can you talk to the tax officer that this is going to be my income, so you give me a certificate. So this is one sort of complexity that happens. But as I said, there have been instances where people have gone ahead and gotten certificate, let's say, for all the fixed price contracts that they have. So for example, let's take our example. We are a accounting consulting firm. I don't know how many clients will I have. So what is the best way out for me? I'm going to, at the first stage, make a list of all the fixed price contracts that I've already signed or are in signing, because I can also go to the tax officer in case of a proposed transaction. And I'm going to put a list of that and try and apply only in the respect of those certificates. Incomes or contracts that come my way later, if they're substantial, I can go back to the tax officer and ask for a new certificate, but that is certainly something that I can do. The other challenge that people face is that there is sometimes no visibility of the income they're going to earn. And when there is no visibility, how do you estimate the amount of the estimated tax or the effective tax for the current year? Now that again depends on the strength of the arguments and the backup information that you have, through which you project the sort of revenue that you expect to incur. Again, you could take a reference from previous years. So if in the last 3 previous years you were doing a turnover of 100 crores and an expense of 120 crores and making a loss every year, it is a fair estimate and a fair proposition to make before a tax officer that this year could turn out to be on similar lines. And therefore, there is a reasonable expectation that you will make a loss, and therefore there is a valid case for the tax officer to issue a certificate. As I said, Vikram, there could be different complexities for different cases, different strokes for different situations, but it's certainly very realistic. As I said, this is something that we do on a daily basis. Multiple, I think hundreds of certificates are issued by one tax officer in a month, in 2 months, and this is something that is a very active practice.
Thanks, Sunil. Even I believe, this is really something which is achievable, and we do this on a ongoing basis. One last question, if I will take others, I need to skip. How relevant is the issue of share premium in the present context? What are the compulsions that lead to this share premium being charged? Yogesh, one last question, if you could take this.
Yes, sir. So thanks for the questions there. The questions have, the question has two aspects to it, sir, how relevant it is. In the current situation, sir, and especially like from 2012 onwards after the enablement has been made, practically one can see that this has been one of the most debatable and controversial topic of the tax laws, the domestic tax law provisions, I would say. So it is fairly widespread, common, and relevant. Now, what are the industry compulsions which leads to this structure? The first and foremost, sir, are doing projects in a separate SPV. For having a different project, be it of real estate, be it of solar, be it of environment, or any other project that we can think of, the roads, bridges, etc. If one were to keep housing several projects in the same company and have multiple lenders to it, the compulsion actually comes from these lenders and bankers who finance up to 75-80% of your project, because they are not able to clearly ring circle their respective roles, responsibilities, obligations, and rights. And that leads to a compulsion from their side to have a project in a separate company. And to manage every other compulsion put together, the commonest form of structure which emerges is that the holdco says that, okay, I will take a loan specifically into the subsidiary company and I will do a project there. This is basically to satisfy the lender and the government officials. So this is the structure, sir. If this were to be relevant to a road construction company, to a bridge construction company, to a real estate company, to a power and infra company, the companies were doing multiple kind of projects in the same industry. And anybody and everybody who's been into this is exposed or compelled to adopt this kind of a structure. And when that happens, how do you finance your subsidiary? The holdco typically issues the shares in the subsidiary company and takes a project which merits and which justifies sharing of the premium at that particular date. The controversy arises that despite doing all the things in a proper, clean, prescribed format, the valuation reports gets challenged, the conduct gets challenged, and it leads to somewhere, if I may use the word, unnecessary, a controversy and a litigation. There were finer points, as I mentioned in my presentation, which are achieving clarity and settlement as we are going ahead. And this is understandably so, sir. This is a 8 or 9 year old provision, and it has come out, I think, in its proper format in front of us. And we are thankfully moving towards final settlement and clarity on this. So I think this is how it stands right now, sir.
One point, Vikram, I'd like to add here is that I think he's given a very valid argument, a reason to say that it's very relevant. Look at another situation. Let's say you have an idea, you want to start a business. You are the contributory of the idea. You are the one with the IP, so-called IP in terms of idea, and the know-how of how to run a process. And the moment you try to capitalize your idea, you will get investments. And when you get investments, the investments will come at a premium. You cannot, there has to be a method to this madness in introducing capital. Now, a provision that was meant to capture, illegitimate money, illegitimate transactions, is actually getting or affecting genuine transactions like these. This is how business is done. One person contributes the idea, the other person contributes the money. And there will remain an issue of share premium. And as long as the only exception the law gives that either my venture has to be an eligible startup, or the investor has to be a VC, or the money has to come from outside of India. I don't think that they have realized the actual reality of doing businesses in India. And therefore, it is as unfortunate as it is realistic that we have to face the situation even today after 8 years of this provision in being. So that's my take on it.
Yeah, point taken, Sunil. And I think this should have answered, the question pretty well. I will just, would like to end the Q&A round. And with this, I would like to thank you, Sunil and Yogesh, for this very enlightening session. This session, has highlighted, in my view, some very important issues, such as the impact of losses on transfer pricing policies of corporates in these troubled times, and the necessity for a robust backup documentation and a justification also. The word of caution on the prosecution's front was very important. The cash augmenting revenues, of course, I mean, you can't undermine the importance. The MAT controversy, Yogesh, that was taken up very well. The advisory on share premium transactions, which we discussed in more detail right now. And last but not the least, the immediate need for the adoption of technology in the tax functions. You know, it is to reduce manual efforts, to increase efficiencies and the accuracies. We have to prepare for all litigation, past, present, future on a real-time basis. And what is the end result? We want to enable the finance leaders to shift their focus from the transactional to more value-added core activities. So with this, I think this has been a wonderful presentation highlighting some very critical and important points. Thank you to the entire ASA team for organizing this, and to the audience for joining us today. We will be circulating a recording of this webinar and a summary of the points discussed to everyone who had registered. If you have any further questions on this or any of the previous webinars, please reach out to our team at webinars@asa.in or kim.kolako@asa.in. I thank you, and have a nice day, everyone. Thank you so much.
Thank you. Bye-bye.
Thank you. Bye. Thank you. Thank you.
Thank you.
Thank you.